can't be just relying on an asset that you have created at one point in time. In a case of a REIT, in a real estate or infrastructure, so once you have built a road, the toll will keep coming every year on year. You don't really have to build the road. You may have to maintain the road on an ongoing basis, potholes, etc. But you really don't need to do any significant business activity on your side. And therefore, the idea for a government which is looking at giving a big boost to infrastructure is that once people have the developers who are really the infrastructure players or a real estate player, once they have built up something, then how can you free the capital for those people so that they can go and take up a new asset? So they can start building a new road, for example. Right? There is a lot of need for infrastructure development in the country, and therefore the government has rightly said that, okay, we will try and give you capital for assets which you already developed, so that you can use that capital and deploy it for developing a new asset. So you can start from scratch at one place, whereas you're already capitalizing or getting the capital back on the assets that you've already developed. So the idea of REITs or InvITs is to really be able to finance what we call as mature or stabilized assets. What do you mean by mature assets? Means that it's already there, the income is being earned on a year-on-year basis. You don't have to do much. You may have to do 5-10% cost in terms of maintenance and operation, but you really don't need to do a big involvement in terms of development, etc. And therefore the income, there is certainty on the income coming for the next few years. So if you build up a building, you've letted it out to tenants, the rentals will keep coming every month. The landlord really has to do nothing much beyond just going and collecting it, and of course maintaining it in terms of security or cleanliness and stuff like that. So really there isn't much that you need to do after you develop it, and that's the type of assets that a REIT or an InvIT for that matter tries to capitalize on and finance in terms of from investors. So what is a typical REIT structure? Just so that it gives the perspective of how it works, and then we get into the tax aspects. So you have a REIT or an InvIT, which is a if you put on the slide there. We're just starting on the REIT InvIT, so it just started about 2 minutes ago. Yeah. So really the way the structure works is that you have a REIT or an InvIT which is set up as a trust. So like a mutual fund where people go and invest, and the mutual fund goes and invests in shares. You have the mutual fund set up as a trust. Similarly, the REIT or an InvIT works like a mutual fund, which is a trust. And then the trust will invest into entities or companies' shares or interest in LLP also, it can go in interest, which holds the stabilized asset. So whether it's a real estate asset or an infrastructure asset, either of them.
Yeah. Okay. So
you have the trust holding shares or interest in a company or an LLP, and the company or the LLP holds the asset. Like a mutual fund, there are obviously investors who will put the money. So who will bring the money? People like us who can go and invest, and of course there are a lot of foreign investors who are wanting to come and set up or take up units. Like in a mutual fund, you take up units, you also take up units of a real estate trust or a infrastructure investment trust. So you typically have one sponsor, who's the guy who is the main person who is bringing in the assets and all that, and then you have other investors coming in, and these units will be listed on a stock exchange. So it will be at the Bombay or the National Stock Exchange, where you have to go and list this under the SEBI guidelines. As in a mutual fund, you also have a professional manager. So the manager's job is to ensure that are the investments the right category of assets that they are investing into. You do a diligence on those investments, make sure that the investor's money is protected and well applied so that the returns are maximized on the investment that are done. So the job of the manager is to really get the best yield or return for the investors. While the manager works also in that direction, there are trustees appointed to ensure that the manager is working in the interest of the investors and not only looking at his personal gain, because the manager is also in a professional capacity, gets income out of it and so on and so forth. So there is a second body, which is the trustees, which are given a custodian relationship to say, okay, you look at the best interest of the investors, and if the managers are not doing what is in the best interest of investors, then the trustees can come in, like in a mutual fund. Also there are trustees which are appointed and which can do that. So this is a structure which is sort of regulated by the SEBI regulations on real estate investment trust and infrastructure investment trust. Until today, we do not have really any of the REITs or InvITs already listed on the stock exchanges. Because there are certain finer nuances on the regulatory side that needs to be ironed out. I mean, over the last 2 or 3 years, we have seen multiple, tax regulations and rules that were coming out in sort of branches to provide a very beneficial or a workable tax regime, keeping in mind the global practices. So when you go outside of India, whether you go to Singapore, there's a very developed REIT market. When you go to the US, for example, Express Towers in the US is one of the the biggest REIT structure, with a $200 million REIT vehicle which is there today, and people have invested in, so on and so forth. So who are typically the investors who will want to come into this? The returns are very fixed, so it is not a case where you get a huge capital gains on your returns. The investors are, the rentals are fixed for 5 years for in your property, so you won't get much higher income. So it is more like a debt return, but it's an assured return because you know that this premises are already been rented out, and therefore the rentals are going to come because the rental agreements are a 5-year contract or a 10-year contract, and therefore there's assurance of the returns that are going to come. But there is unlikely to be any substantial year-on-year or quarter-on-quarter growth in terms of the income because the asset is fixed. You can't add on more typically. Yes, over a period of time, 5 years, 10 years down the line, when there is an appreciation in the value of the property per se, because as we know in India, the property prices have always appreciated until now. And when there's an appreciation in the value of property, the REIT is entitled to sell the property and earn a higher capital gains or value appreciation at that point in time. But the regular income that will typically come will be in the nature of rentals in case of a real estate, and in the case of an infrastructure asset like a road or a power plant. Again, power plant which is running up to 100% capacity or fixed return coming in from the state electricity boards and stuff like that. So it will be a fixed return that will be coming annually, and therefore the way the investors are marketed is that you will earn a fixed yield like an 8%, 9%, 10% yield on the money that you put in, which is more like a debt fund in a way, but really is income or dividends flowing from the whole structure. So, I'll not get into too many of these SEBI regulations, that's not the focus of what we're going to discuss, but, it's important to know that there needs to be a sponsor. Typically, you are seeing the sponsors, the category of sponsors who will be in the market are either the developers themselves, so a large infrastructure developer or a real estate developer, like a DLF can, for example, sponsor a REIT. I'm just taking names by random. Unitech can go and sponsor a REIT. So these are large real estate developers you will see, or you can also see some of the large private equity funds or financial services players like a Blackstone and GIC. Just 2 days back there was this news in the Business Standard that they are all accumulating such yielding assets, and therefore once they get to a particular size, they will probably list it in the form of a REIT or an InvIT at some point in time. So those are the type of sponsors that you will see and will emerge as we go there.
In this slide, Vishal,
yeah.
You indicated the sponsor directly investing into a company or LLP. So they would invest in the REIT also and in the directly assets, LLP also?
Yes. So the sponsor has to hold a minimum. He's like a promoter.
Right.
In a promoter in a company, when you list the company, then you have to have a minimum promoter shareholding. You cannot be sort of divesting out 100%. In the immediate, in the next 5 years, there are time horizons within which you can divest 100% out as well. But what will typically be happening? So let's take a DLF for example, and just to talk about it without sort of really the name being relevant. But let's say DLF is holding already a commercial real estate where rentals are coming on a year-on-year basis. Now DLF says, I'm getting my normal rental income and therefore the routine income up, but I would not want to only get the rental income. I would like to encash my commercial asset. So what I'll do is they are allowed to transfer this asset company in which the commercial real estate is there into the REIT structure. So this asset company can come in where the REIT will really hold, at least hold 50%, but it has to hold beyond that 50%. If the sponsor is say holding 100% here, then the conflict of interest rule says that you cannot continue to hold through the REIT and through your answer there.
Yeah.
The conflict of interest will not allow it to happen and hold it here. But let's say if the sponsor is not DLF, but the sponsor is Blackstone. So DLF can continue to hold 20, 25%, 30%, 40%, less than 50%, because at least greater than 50% is something which the REIT has to hold. So it has to be less than 50%. The balance portion can be held by DLF as the existing shareholder, and the sponsor like a Blackstone or somebody who's not necessarily the developer himself can hold through the REIT, but he has to hold 25% in the REIT. Yeah. If DLF was to be the sponsor, then it cannot have two investments, one directly and one through the REIT. It will have to swap everything into the REIT effectively. So that's the way the conflict rules also work.
Basically, if it is DLF wants to set up their own REIT, they will have to shift everything.
100% of the asset.
And if there is no capital gains exemption for that.
There is an exemption
There is.
For that also.
For
Yeah,
If
there
you
is.
want to shift.
Yeah.
Then-
So
then
if
why
you-
do we want to then involve Blackstone hypothetically? If
No,
they would
because-
rather prefer, if say for whatever reason, if there is nobody, he can also encash it without relying on any PE investment.
Which is right, but what happens, Jimit, is that a DLF, there are rules as to concentration limits. For example, if DLF is the sponsor, you cannot, as a REIT, hold more than 25% of your assets in DLF assets or DLF properties.
Your own assets.
Because otherwise, what will happen? They will take money from the public investors and only acquire their own assets 100%, which is not permitted. So there are concentration rules like in an NBFC, for example. If you are the promoter of the NBFC, or in a bank, for example, if you are the promoter of a bank to your associate companies, you cannot lend more than 10, 15, 20% of your investable surplus.
More than 75% third party
investors. So similarly, the concentration rules apply. So if DLF were to be the sponsor, for example, then it has to go and acquire other companies or LLPs which own real estate projects from, say, Lodas or Unitech or the others. They have to mention the concentration limits over a period of time. So therefore, that will the market forces will decide. Like a Blackstone at the top of it, it doesn't have any of its own assets really, because it is only an investor in any of the others. It's not developed those assets on its own. So Blackstone can hold assets acquired from DLF, can hold assets acquired at Express Towers, for example, and so on and so forth. So it can hold multiple different developers or promoter assets under the REIT, whereas the DLF can only hold up to 25% of its own assets, and it has to hold the others. So there are concentration limits which will not permit DLF to be 100% of its own assets being encashed.
This is as per SEBI regulation.
As per the SEBI regulation, obviously, because those are governance norms that they have put in to ensure that the investors' money are not only put into their assets.
If DLF is not a sponsor, then it can go up to 74% of the owning.
It can
the
go,
REIT, right?
Absolutely, because it's in a public investor.
Yeah.
Yeah. So if you look at these, for
If they
example,
are a sponsor, then they're 25 only, right?
they can hold at least 25%.
25.
They can go beyond that 25%, but
concentration limit also,
minimum 25% has to be public. So they have to hold 75% in the REIT. Like in a listed company today, say promoters can own up to 75%, and the balance 25% is the minimum public float. So same way in a REIT also, you'll have to have minimum 25%. DLF can own anywhere between 25 and 75. Effectively.
Correct.
In the
But it's
REIT.
not in their interest to hold more.
Because the idea is to encash. So if they keep holding, then they are really not getting the value for the asset and reinvest that for developing a new project or a new asset. The purpose really, most people will be to sort of divest, but they are giving that you hold a minimum 25%, so you don't run away in a way. You have put your skin is still in the game in that sense. That's the purpose of it. So as I said, a sponsor can be either the developer or a financial services, with the experience in real estate development or infrastructure development, managers, trustees. Again, these are professionally, people who are in that field of professional management, Blackstones, JP Morgans of the world, where you see us, even the mutual funds, Kotak funds, and all of those are professional managers, and they will become the managers in this entity. Asset-related conditions, as I said. The minimum is that 80% of the value of a REIT is to be in completed and rent generating real estate. So you cannot be investing in assets which are underdeveloped. You have to invest in assets which have already been developed, and there is a routine income or an annual income being generated out of that income. That's the minimum investment that you need to do with a lock-in period of 3 years. So again, the idea is not to keep buying and selling or trading in properties. The idea is to hold that asset, earn rental income on an annual basis, and pass it on back to the investors. That's the structure. This is not a structure where it's a developer company which will buy or trade in real estate or infrastructure assets. It is a structure where you really get benefit only by your annual yields or returns on those assets. You can have 20% in under construction or development projects. So the balance limits can be applied there. Again, as a distribution policy, whatever income it earns, the distributable surplus that it makes on a year-on-year basis, at least 90% has to be distributed up by way of dividends. So you will typically see these funds will give dividends on an annual basis. Whatever during the year income you have accumulated, at least 90% has to be distributed up to the unit holders.
In the previous slide, so you mentioned about that 80%, 20%.
Hmm.
So in terms of the inflow, when the sponsors invest in the public, etc. So if there is a fixed
Transition time given.
or there is a fixed amount up to which you can collect, so that you can determine 80% and 20%, because suppose if the money keeps on flowing in that particular rate,
Right.
then that 80%, 20% also would be fluctuating.
So yeah, so unlike a mutual fund where you can go and invest or redeem your investments at any point in time, the REIT will be, or an InvIT will be like an IPO. So the way the IPO works is that you will at a given point in time open the window for
Right.
people to come and invest. Right? So at that time people will subscribe to your shares
So
and you will issue the units.
it has to be listed.
Now it is closed. Right? So now it is not ability, there is no ability to further invest unless you do like a QIP or a private placement at a later point in time.
Correct. So they have collected 500 crore, then it
The 500 crores is your capital base.
It's not an open-ended.
It's not an open. It is
Same as
open-ended
listed
in the
also.
sense it's listed on the stock
But
exchange,
exactly.
but you cannot further issue
No,
units.
open,
Right.
that listing is what is there, you go and buy and
Correct,
sell.
go and buy and sell. You cannot
But the
issue
initial-
more units.
You cannot issue.
Unless you do a private placement at a later point in time, like a listed company.
Yeah.
That's it. So you can get further capital raising in a round 2 or a round 3.
Right.
But again, that has to be like a rights issue or a public issue or something like a QIP or something.
correct.
Again, public offer, as we said, minimum value of the REIT has to be 500 crores. So your REIT assets aggregate value has to be up to 500 crores. Minimum public float is this thing. You can get retail investors. You again need a minimum of 200 subscribers. So you can't just issue to one public party, private party and say we are listed, because it is meant to be a public investment vehicle. So it is not only for that you can only take 10-15 investors and say we are listing a REIT. So you have to have minimum 200 subscribers at that point in time. I mean, I'll not go into all the leveraging, how you can borrow, etc. Because that's quite getting involved in terms of it. But let's come to the case study in terms of where it is relevant for international tax investors. You will typically see when these things happen in the marketplace that the most category of investors here will be the foreign investors. It will not be people like us who will want to invest in these type of assets, because if we want to get an 8 or 9% yield, it's very easy to get it through a fixed deposit. You really don't need to go and invest into a situation like it. But really, when the type of investors that will get attracted to this will be your pension funds in the US, UK, Europe, who are happy with a 3 to 4 or 5% fixed return, because that's the interest rates that they get there. So if they can borrow at 1%, they are very happy with a 4% assured return, because they are getting a
Widespread,
arbitrage, in terms of the 1% that they pay interest there and the 4% that they earn here. So you will typically see all of those. There will be Indian sponsors like a DLF, as we said in our example, or even some resident holders. But really, I don't see this numbers to be that high when it eventually happens as a listing. You will have the large part of it being held from overseas. So we've, in our example, let's take a case where we've had MCO, which is a FII out of Mauritius, which is investing into the property REIT. So it's not an infrastructure REIT, it's a property REIT. So to that extent, this structure is likely to happen. You have a Singapore company coming and investing, a Chinese company, and then there are other unit holders. And since we are also going to look at indirect transfers rule under this as well, the MCO is held by a Hong Kong company, PQR Limited, and the other investors of 70%. So that's just a background facts so that it's relevant to be kept in mind. As part of a typical structure, you have a property REIT here, which is the trust that is set up, which is holding equity and has invested by way of debt in the SPV, the company or LLP, and then that company holds the real estate project. So a building which is earning rental income on an ongoing basis. So that's the question, and the fair market value of the project is, let's say, 2,000 crores. So that's what
It has to be the SPV for each project, right?
Typically, you will have an SPV for each project, but the rules, the SEBI rules will allow you to also hold, instead of doing it through an SPV, you can directly hold the assets.
Directly,
So
So the SEBI rules do allow you to do it, and the second case study we'll see is what happens if it's holding
Directly
assets
hold.
directly. So what is the difference, or the tax rules work differently in this situation? So the question that in this case study we had put up was that just to understand the basic provisions of the law as to what is a preferred SPV vehicle. Is it a company or is it an LLP? So if you are structuring, you are told to structure this REIT, what would you prefer? What would you advise your client? Whether you should set up the SPV as a company or an LLP, because you have a choice to do one out of the two. And the SEBI rules allow to invest either in a company or an LLP. So which one would you do? And therefore, that's the question that we will evaluate to say, okay, how does the basic rules of a REIT taxation work when the investment is done through a company, and is it different when the investment is done through an LLP? So let's take the first situation where the SPV is a company that is set up. So let's say the REIT holds SPV, which is a company, and which in turn owns the project, and then there are unit holders, and for the time being we'll only consider international for foreign investors, because that's the purpose of our international tax meeting that we are having here. So we'll not really take domestic unit holders, because those are very straight jacket answers, but insofar as an international investor, the rules work very, very differently. So because the REIT has equity investment in the SPV and has debt also put up, so you can also give a loan, and that is allowed under the FEMA rules as well. There are the three types of income that the REIT will earn from the SPV. So the first level of income will be from the project. So you will earn rental income, the SPV will earn rental income, you will have to pay tax on the rental income, and then whatever is the surplus that the SPV has will either go up by way of interest on the debt that the REIT has put in, or by way of dividends on the equity that it holds. So the balance will go by way of dividends. And if at all any point in time in the future the REIT were to sell the shares in the SPV, you will have capital gains in the hands of the REIT. So these are the three incomes that the REIT will earn, and in turn the REIT will distribute again the interest or dividends to the unit holders, because 90% of whatever it earns has to be distributed back to the unit holders on an annual basis. So it will on an ongoing basis distribute the interest and dividends up. And also when a unit holder sells the units, because they are listed on a stock exchange, you can always sell your units, there will be capital gains for the investors coming into the REIT. So these are the sort of streams of income which we will discuss as to how it works in terms of the basic rules. We need to know here that it is not that the Income Tax Act has provided for special rules on how to tax REITs. So while there is a separate rules on trust taxation under the Income Tax Act, those trust taxation rules are overridden insofar as the REIT is concerned, because there is a special regime to incentivize investment. So there is a better regime which is provided, and therefore that's the more beneficial regime that we will look at. So there is a concept that they have put in that some of the income will be taxed in the hands of the REIT, and some will not be taxed in the hands of the REIT, but will directly be taxed in the hands of the unit holders. And for this purpose, to ensure which is what income, because once the money comes into the REIT, it becomes fungible. One doesn't know whether it is interest or dividends, it is cash in the hands of the REIT. So they have said that whatever the characterization of the income when it is distributed back to the unit holders will remain the same as it was that the trust had received. So if the trust received interest income and then there is a distribution back, then that proportion of it will be interest income. If the trust had received dividends, then that proportion of it will be dividends out of the distribution. And if the trust had earned income by your sale of shares, then again in the hands of the investors also it will be treated as if it's a sale of shares. So the income character will remain the same on a pass-through basis wherever the income is taxed on a pass-through basis. So in some cases, like interest paid by an SPV company, so this interest on the debt which is paid to the SPV, it is on a pass-through basis, which means that the REIT is not taxed, the unit holders are directly taxed. So the REIT is not taxed here. The unit holders, in case of a non-resident unit holder, which is what we are looking at, foreign investors, gets a beneficial rate of 5%. Typically the interest rate in India under treaty also is like 10%, the lowest that you are able to get in the Cyprus treaty or something like that. But here the domestic law itself gives a beneficial rate of 5% on the interest income that will go to a foreign unit holder. For a resident, it will be of course the applicable rate, so it's 30%. So it's not really a structure which will work very favorably for a resident investor, because their intention is to get more foreign investors to come and invest in this. So a resident investor, a unit holder will get the applicable rate. Dividends. Now this is a very important. Dividends is an important one, because in a normal course when a company pays any dividends to its shareholders, you have to pay the dividend distribution tax. An Indian company paying, whether it's foreign shareholder, Indian shareholder, doesn't matter, you pay dividend distribution tax. However, as part of the special regime that is provided to REIT, they have said that if the shareholder of the company is a REIT, then insofar as that shareholding is concerned, the company is not required to pay dividend distribution tax as well. As also the fact that the same dividends will continue to be exempt in the hands of the trust, which is what otherwise the shareholders is not taxed in respect of dividends, except, and the 10 lakhs tax is also not applicable. If the dividends cross 10 lakhs, that is also not applicable for a REIT. So it is fully exempt right through the system. So if you see dividends, it is fully exempt at the end of the company, which it is exempt in the hands of the unit holders, and the REIT also does not pay any tax insofar as dividends are concerned. So this is a very significant advantage of a REIT structure where you can mitigate the minimum DDT, which is also applicable in the normal course for any real estate asset. So that's where the structure will work very well even for a resident investors insofar as dividends are concerned. Then when you sell the shares of the SPV company, there is no pass-through treatment, which means that the income is taxed in the hands of the trust, the REIT. It's not passed through and taxed in the hands of the investors, but it's taxed in the hands of the trust. In which case, of course, the unit holders, when they get the distribution, they are not taxed because the trust is already taxed in respect of that income, and the trust will be taxed as if it's sale of shares of an Indian company. So today the rate is 20%, and this is a domestic law rate. So we will come to the fact as to what happens because the investors are non-resident. So we'll deal with that specific fact a little later. Again, when you sell the units of the REIT, because it's a listed unit that the unit holder is holding, the STT will be payable on that, and the long terms will be exempt, short term will be taxed at 15%, like any listed securities are to be listed shares are being taxed. That's how the broad framework that works in a case of a REIT. When the SPV is a company. Now let's look at a case where the SPV is an LLP. This becomes a little more tricky because typically the interest, the LLP is treated as a preferred vehicle because it does not have a dividend distribution tax. But that advantage is going away here because in a REIT situation, anyways there is no DDT for our company structure. So that advantage or a basic advantage of wanting to set up an LLP is going away here. And look at the situation where the interest is paid by an SPV to the trust. Unlike the company, this is not on a pass-through basis. So if you see the company here, this is on a pass-through basis, and there is a 5% lower rate on that interest for the unit holder. So ultimately, the interest is only taxed at the rate of 5% from the company. Whereas in an LLP, if the LLP pays this interest, the unit holders are exempt, but the REIT is taxed at the maximum marginal rate, which is 30%. Okay? So you will have a situation where if the company was paying interest, it is taxed only at 5%. Whereas the same interest being paid by the LLP to the ultimately which goes to unit holders suffers tax at 30%. So an LLP structure may not necessarily be the more viable structure in this situation, especially when you are looking at a REIT investment. Dividends again, because in a LLP anyways there is no dividend distribution tax, it's share of partnership income for tax purposes and therefore it's exempt right through, same as in a company. Exit from the SPV LLP now becomes an important thing because it is not passed through like the company situation, but because the LLP is treated as a partnership, you can structure the exit in a manner that on retirement from the partnership, you are really not required to pay a capital gains tax. Whereas in a case of a sale of shares of a company, you will necessarily have to pay a capital gains tax. So that's the advantage in an LLP situation where the capital gains may be exempt. Of course, it depends on the mode of the transfer. If you are selling your stake in a partnership, then the answer is different. Versus retiring, then the answer is different. The NMOD case and stuff like that. So that clearly can be different. The REIT, of course, is taxed or not taxed depending on the mode as we discussed. And again, insofar as the unit holders in the REIT units are concerned, it is the same as a company because there it's listed, STT paid, and so on and so forth. Now the critical issue insofar as the income taxation is concerned is that let's say in our structure you have a case where one of the investor is a Mauritius company, right? This Mauritius company holds 25%. So really at this end the trust, the income is clearly earmarked to the extent of 25% for a Mauritius investor, to the extent of 10% for a Singapore company because they are the unit holders and they are entitled or the beneficiaries of the trust which is represented by way of units. So in a situation where the trust is taxed, what is the regime under which it gets taxed? Now if you know clearly while there is a specific provision on the taxation of REITs, it says that insofar as the income which is taxable in the hands of the REIT, we will go back to the trust taxation rules. And the trust taxation rules are contained in section 160, 161 and 164. And there you have to determine whether it's a determinate trust or an indeterminate trust. In normal trust taxation rules that we consider. So what is the test of it being a determinate or it not being a determinate trust? And there if you see, it is important to look at the explanation 1 to section 164. Let me just go back to So let me first go to 115 UA. Then go wrong side. So if you look at, this is the section 115 UA which deals with the taxation of a business trust, and the first para it says, which we discussed, that the income distributed will be deemed to be of the same nature, the same proportion in the hands of the unit holders. That's what we've already done. Subject to the provisions of 11A and 112, which is dealing with taxation of long-term and short-term capital gains. So the rates for long-term and short-term will be as per this. The total income of a business trust shall also be charged to at the maximum marginal rate. So now when you have to determine the total income of the business trust, you will have to necessarily go back to looking at the provisions of section 161 and 164, which is a section that applies to a trust. And insofar as trust is concerned, you have to again determine whether it's a determinate trust or an indeterminate trust. Section 164 explanation says that when it is treated to be treated as a determinate trust, and in that context it says that it is deemed to be determinate if the person on whose behalf or for whose benefit such income or part thereof is receivable during the previous year is expressly stated. So the beneficiary who is entitled to the income, the name of that person is beneficially stated in the instrument of the trust and is identifiable as such on the date of the trust deed that you create. So is the name of the beneficiary, which is the investor in this case, specified in the trust deed? That is the first test. And then you also need to know what is the proportion of it. So it's not just good enough to know the name of the beneficiaries, you need to know what is the proportion in which it is divided, because then the determinant works both in terms of the identifying the beneficiary and the share of the beneficiary as well. So the share should also be individually known. And again, the same rule applies and says that the individual shares of the persons or the beneficiaries are expressly stated or are ascertainable from the trust deed. Now, in a typical trust structure like this, where you've had mutual funds or you have private equity funds, etc., the trust deed may not be in a position to say on day one who are the investors, because the investors really come on a later date when you do a public offer or you raise capital at some point in time. So you are not in a position to say that the names of the beneficiaries will always be written in the trust deed. It is impossible, because the trust deed would have been done at the first instance of setting up the trust, and the investors really come in at a later date. There may be some beneficiaries whose name may be written, because the sponsor, for example, may have his name written to that extent, but not everybody. And therefore, this issue came up in the past in the case of AIG, a very advanced ruling had the occasion to say that if the trust deed provided the basis of determining the beneficiaries and the percentage share of each of those beneficiaries, then by that formula being provided in the trust deed meant that you could ascertain the beneficiaries even if their names were not specifically written in the beneficiaries. So for example, the trust deed will say, to determine the beneficiaries of the trust, you have to look at the register of unit holders of the trust, and whoever names appear there, and qua the number of units that they hold in the REIT, they are the beneficiaries to that extent. The percentages will be easily ascertainable. And then the AIG ruling went ahead and the advanced ruling held and said that in such a circumstances where even if a formula is provided or a method is provided in the trust deed to determine the beneficiaries, then it is not necessary that the names of the beneficiaries should be in the trust deed or their percentage share should be in the trust deed. And if you can determine it, it will still be treated as a determinate trust. So the advantage of a determinate trust, so will be now in a situation like this, the distinguishing factor could be that the AIG ruling dealt with a closed-ended fund. So it was not a listed fund where the unit holders keep changing on a day-to-day basis, because in a listed fund you can sell units on any day and the unit holders will keep changing, although it may not happen that much in a case of a REIT, but there is a possibility that the unit holders keep changing. So the question really is that whether such a rule that the AIG ruling has applied will continue to hold in the case of a REIT or not, and why do we need to apply that rule? And the reason for that is that, as we looked at there in the slides there, what does section 161(1) says, that if it is a determinate trust, then the taxability of the trust will be in the same manner and to the like extent as in the case of the beneficiary. So now, when the REIT sells the shares of a company, Indian company, we said earlier that the REIT would be taxable as capital gains on the sale of the shares of a company. But if the beneficiary of that REIT trust is a Mauritius company, and the Mauritius company under a tax treaty is allowed to claim exemption on sale of shares of a Indian company, then the question is that to the extent of the Mauritius company shares, is the REIT allowed to claim exemption, because 30% of the income of the trust is really belonging to the Mauritius company. and that is possible only if under section 161 the REIT qualifies as a determinate trust, because the determinate trust allows you to tax the income in the hands of the trust as if it would have been taxed in the hands of the beneficiary. And if the beneficiary is a Mauritius company and the Mauritius company having sold shares of an Indian company would not have been subjected to tax in India, then to that extent of 30%, the trust should also not be subjected to tax in India. So that is the advantage of trying to apply the provisions of section 161(1) read with 164 explanation to say that it is a determinate trust, and once it is a determinate trust, you determine the taxability as if it is earned directly by the investors. In our case, most of the investors will be foreign investors who will have access to a treaty like a Mauritius or a Singapore, which will allow us to claim exemptions for the capital gains that are there.
In which case, it has to be a company and not an LLP.
We are looking at a company situation, because in LLP you can claim exemption in other manner.
But AIG ruling has not been challenged by department?
In the department, no. So that has been accepted. And very recently we had this similar issue coming up in the case of the AIFs, the Alternative Investment Fund vehicle, which is also a SEBI registered vehicle, it's a private equity fund essentially. And there also the CBDT actually came up with a circular supporting this argument to say that the CBDT again said that yes, the provisions of section 161 and 164 are relevant in a case of a EIF, which is also structured in a very similar manner like a REIT. Except that in some cases it is listed, some cases it is not listed. So there can be a difference on basis of actual listing required or not required. But the structure of the trust and the investors is very similar in an AIF as in a REIT. And in that case also the CBDT confirmed that you can apply the provisions of 161 and 164. Yeah?
But the board circular is again, they think that it has to be because it is indeterminate, so it has to be taxed in lines
No,
of
the
the
board
trust.
circular is actually worded in a little different manner, but it does allow a case where if the investors' names are mentioned in the trust deed and their proportion is also mentioned in the trust deed, then it does permit that you will go under 161. It works, the board circular reads in a negative way, and it says that if it is not named, then the provisions of section 164 will apply and you will be taxed at the maximum margin rate. Which means that if it is named and the proportion is there, then you can apply the provisions of
I think
section
most of these trust deed would never mention the name of the...
Yeah, and then to interpret that you have to rely on the AIG ruling and say that if the name of the beneficiaries and their share can be known from the unit holder register of the unit holders, then the AIG ruling allowed it to be said that it is determinate, and therefore it is as good as if it is written in the trust deed itself. So that's where you need to rely on
They
the
are
ruling.
listed there on changing, but at one point of time,
You will know.
at one point
On the date of the distribution, you will know who are the beneficiaries of this trust, because there will be a unit holder register being maintained by your registrar, and that will give you the list, because you have to send the dividend check. Whom will you send the dividend check unless you know the
So it is
investor?
determined at that point of time.
So at that point in time it is determined. At the time of the distribution, it will be the unit holders who are holding the units in the trust deed.
But the provision says that you determine at the time of formation of the trust, at
Correct.
the time of creation of the trust.
Correct.
So subsequently you will have the register and you will have all the name of the investor.
Right,
But at the time of creation of the trust,
right.
the difficulty would arise because that time you would not know who are the investors because the process would start little
Correct.
later on.
Yeah. So the way the advance ruling interpreted the provision at the time or in the trust deed, they said that if the trust deed will have to necessarily mention who are the beneficiaries. So they will write that the beneficiaries of the trust will be the persons who hold the units in the trust. And therefore you can still determine that while their name is not written,
Yeah.
but you can say that whoever name appears as the holders of the units are the beneficiaries of the trust, and that determination is nowhere else except in the trust deed. And at the time when the trust deed is created itself.
At least when income is distributed, you will always know
No,
who are the
time,
beneficiaries.
that time
No,
you will
even
not.
the trust deed will have to provide for who are the beneficiaries, and they will say they will not be able to name it
Because I am
is A and B.
just referring to the specific language of the
164.
provision 164.
Absolutely.
And they are mentioned at the time of creation of the trust.
Yes. And then the way to read that at the time of creation of the trust is that has they provided a basis of determining who the beneficiary and their proportion is? The mechanism is provided, and the AIG ruling said once the mechanism is provided in the trust deed, it will satisfy the provisions of section 164.
None of these trusts will become.
Exactly. So that's the advantage of saying that if I hold units through a Mauritius company and the Mauritius company is eligible for the treaty benefits, then to the extent of the capital gains on those benefits, I can get an exemption.
We shall by 5 minutes to have this.
No,
We are all eating.
No worries. I'll take it on. Don't worry. No,
We
I'll
will ask you questions.
No, yeah,
We are
no.
all eating.
Okay, so we discussed this. I think the other part of the issue was also whether the provisions of indirect transfer would apply to PQR Limited. So let's say if PQR Limited were to sell the shares of the Mauritius company, right? Whether under section 9, the new explanation 5 and 6, which is also a case study that we'll deal with maybe later on, would the indirect transfer rules get triggered in the case of a PQR Limited? And the answer to that will be yes, because this is a company overseas which derives its value substantially from India assets, and a REIT will be treated as an India asset because it's only holding shares of an Indian company or an Indian project, and therefore the indirect transfer rules can also get triggered when somebody is holding units in a unit holder, or for that matter even in a mutual fund or a private equity fund. Ultimately if there's a transfer of shareholding.
They have been ruling that they can have investments in other countries also.
The REIT in India cannot, but of course this Mauritius FII could have invested in other investments in Singapore, etc. But the REIT cannot have invested outside of India. The REIT will only be able to, because it's SEBI registered and will only invest in India. And mostly these type of structures, they are qua country, so they don't allow the placement memorandum will typically restrict the investment to the country and the investors there. Just taking this concept forward into a different situation where, as we said earlier, that you could either invest into the asset through a SPV or company, or the REIT can directly hold the property itself. So here you don't have an SPV or a company, and the REIT is directly holding the investments in the business center, for example. Again, a business center is a typical REIT structure where you earn rental income or service income for whatever services that you provide at the business center, and you really don't have much to do there. So unlike our old structure, the first case study, you don't have an SPV, which is a company or an LLP here. The REIT is directly holding the asset. And now you have Mauritius and other foreign shareholders as unit holders in this business center REIT. So let's first look at how the basic provisions work. And here, if you see, the income that will be earned by the REIT will be first the rental income from the asset itself. So as a landlord, it will collect rental or service income from the tenants of the business center. So directly holding the project assets, so therefore it will directly earn rental or business income. Basically it will be surplus profits, business income profits, because it will have rental income and costs on maintenance, etc. And that's the surplus profit it will earn. And then of course it can sell the center, the project itself, and the unit holders can sell the REITs. Now this is very standard one. When you sell REITs, it's a listed thing. Let's look at these two typical cases of income. In a case of a rental income like this, the REIT is not taxed because there is a pass-through basis provided under the law, which means that the unit holders are directly taxed in respect of that income and the REIT is exempt. Now, therefore you have to see whether this rental income will be, how will it be taxed in the hands of PQR Limited Mauritius, or this rental income, how will it be taxed in the hands of the other unit holders, for example. Now let's take a case of a Mauritius just so that it gives the perspectives on what the issues involved are. You will have the Mauritius, let's say, is holding 30% of the units. So the 30% of the distributable surplus, which is there at the REIT level, which is basically nothing but profits, surplus profits in the hand of the REIT from the business center. That income will go and sit in the hand of the PQR Limited, and you have to file a tax return for PQR Limited Mauritius because it is taxable in respect of this. Now you look at PQR and say, okay, PQR is a Mauritius company, is eligible to the treaty benefits under the India-Mauritius tax treaty. So the first question that you have to decide is, what is the character of the income in its hands? Now we looked at the basic provision which says that the nature of the income will remain same in the hands of PQR Limited. So if it is rental income, less profits, less expenses in the hands of the REIT, it will exactly be the similar in the case of PQR Limited for its share. Now the question therefore is that what will be the income characterization when you apply our income heads? So the two possible will be income from house property or income from business. I mean, these are the two possible situations which will land up here. Now, in a case of recently the Supreme Court in the case of Chennai Properties has said that when you have acquired developed assets and you are only holding it for earning rental income or leasing it out, then that income is in the nature of business income. So therefore, if you apply that characterization, you will have to look at PQR Limited Mauritius and say, okay, this is in the nature of business income for PQR Limited Mauritius. Right? Yeah. Do we go there? So we'll come to that point, in that sense. Now, the question is, what happens insofar as the characterization of this income is under the treaty? Because if you take it as business income, you might end up to say, okay, there is a business connection under the domestic law for the Mauritius company. If you just evaluate the taxability of PQR Mauritius under the Income Tax Act, don't go to the treaty for the time being, because you have to see whichever is more beneficial. So let's say you are just first looking at saying, I will look at the domestic law. PQR Limited, there is a business connection because it is invested in a REIT as a vehicle, and therefore the business income is taxable in the hands of the Mauritius entity under the provisions of the Act. Now we therefore go and look at the treaty provisions and say, okay, under the treaty, how will PQR Limited be taxed in respect of this income? And there you will have Article 7 dealing with business income and Article I think 10 dealing with immovable property, for example. Okay. Now Article 7 in the treaty says that if the income is dealt with more specifically by any other article, then you have to apply that other article in determining the taxability, not the business income article. Now, unlike the Chennai properties decision, the article dealing with the Mauritius, in the Mauritius taxability with immovable property does not distinguish between business from an immovable property or not a business from an immovable property. And there they have said that is the income derived from an immovable property? And the answer is there is no doubt that the income is not derived from an immovable property, because the only way the income has been derived is from that property or the asset. The entire income is the rentals that you have received from that property. And therefore, under the treaty, you will look at to say, okay, is the income from immovable property? And therefore, it is not called by Article 7, but by Article 10 of the India-Mauritius Tax Treaty. And Article 10 of the India-Mauritius Treaty says that if your income is derived from immovable property, then it will be taxable in the source state. It doesn't give the basis of how it will be taxed. So you have to again go and determine the basis under the domestic law. Now you are therefore in a circle situation where the domestic law was not favorable. You went to the treaty. The treaty says it is immovable property, so you come back to the domestic law on how to tax it. Now when you come back to the domestic law, the question will be, do you apply income from house property, or do you again go back to income from business or profession? So you are getting into a little circular role. And then possibly this will evolve obviously, but one view would be to say, okay, if you have decided the characterization of the domestic law, that it is business income, yeah, because the Chennai Supreme Court decision has very clearly said this is business income, then insofar as that characterization is concerned, the treaty cannot override what is more beneficial to you. If you think business income is more beneficial, and of course business income will be more beneficial as we see, because you can argue no P, no tax under the India-Mauritius Treaty for business income, not for an immovable property. So if you can read a conclusion that the characterization is decided by the domestic law, that characterization is undoubtedly laid down by a Supreme Court that it is in the nature of business income, and therefore when you go to the treaty, you don't have the ability to then say, okay, whether it is business income or house property, you have to go to the clause dealing with business income and then apply Article 7 read with Article 5. Yeah? And you will be having at least a good argument to say there is no P, because really PQR Limited Mauritius has no control on the asset. The asset is that of the REIT. It is managed or controlled by the professional manager. The PQR is not able to take any decisions in respect of that REIT. So therefore, is that asset at the disposal of PQR Limited to evaluate the P? Clearly it is not at the disposal of PQR Limited to evaluate the P. Yeah? And in that case, PQR Limited cannot be said to be having a fixed place P. There is no other case of any other P possibly coming. Construction or service is impossible.
Also, Vishal, when we look at the domestic law, when we say that it's a business, you also in the treaty first check whether it's FTS, royalty, and then go to the business.
Yeah.
So then if going by that logic, I should have directly gone to business and I should not have evaluated royalty, FTS at all.
So, for example, in one of the tribunal rulings in the case of BCG, which is a reported ruling, they had decided that it is in the nature of fees for technical services under the domestic law. And the question was, they came to a fact that it is not fees for technical services under the treaty because of the make available argument under the treaty. Therefore, said this consulting income is not in the nature of make available and therefore it is not FTS. And then they said because it is not, there is a P and therefore you have to decide the taxability under the business income in India. And when they looked at that situation, the tribunal said, once you have decided that it is not FTS under the treaty, you don't have the option to again evaluate whether it is FTS under the domestic law or not. You have to stick to the business income article, because in the old days, in FTS, as you would know, for a foreign company, there was this section 44D, which said that you have to be taxed only on a gross basis without deduction of expenses in the old days. So this was 2001 or 98, 99, 2001. So at that time the tribunal said that once you have decided the characterization under the treaty that it is not FTS but only business income, you cannot come and while the treaty brings you back to the domestic law, because the business income brings you back to the domestic law, you cannot change the character again and say it is FTS and therefore taxed, and the 44D will apply. Although under the domestic law it is very clear that it was FTS income, you know.
How good is this feasible?
Sorry?
How good is this feasible? I have not heard Boston followed ever after it done. And I remember the logic which Pramod Kumar had given in that.
Yeah, exactly.
He said that the door is the section heading, and if you can't enter the door, then you can't enter the section.
Correct. You know, so no, you're right. But even if you take, let's say, I mean, as I said, this is just an argument. But let's say, even if you take the position it is immovable property, it will bring you back to the domestic law. And domestic law will say again it is business income because the Chennai property is applying, and it will be taxed in that normal
All it
process.
says, Article 6 of Mauritius Treaty says removable property, like any other article removable property, then where the situs is of the property, that will be taxed. Of course, under the domestic law, you ask for the computation of the domestic law. Domestic law says it is to be taxed as business income, it will be taxed as business income.
No.
So, even in the absence of a P, that is what
the question really is that will we be able to stick to the characterization that has been agreed
So
in a way,
that's a
and
discussion.
you know, that's the point of discussion that we left to go.
Once you follow in the article,
This gives me time to eat because
Yeah.
we have a lot of people.
once you are covered by Article 6 of the Indo-Mauritius Tax Treaty as the whole property, then probably you are going to domestic tax law only for the computational purposes and no other purposes, because computational is only the prerogative of the domestic law thereafter. So you don't pick and choose again between immovable property and a business for the purpose of computation, because treaty has clearly directed you towards the whole property. Then you go to scheme of tax section 24 to 26.
And therefore,
it will be more
house property taxation,
Of course,
house property
of
taxation.
course.
Then you're going to get Chennai properties.
So then you don't apply Chennai property, I'm saying, because treaty has already decided the characterization. You're only going for the purpose of computation.
That's the third view. That's the third view.
One proposition is treaty does not determine the characterization. Treaty just gives you allocation. The distributive rules. Who has got the right to tax?
One second.
Which country has the right to tax? If you take it that way, you might have
In Indian Netherlands tax treaty, the dead animal is an immovable property.
Yeah.
Right. So once it is decided as immovable property under Indian Netherlands tax treaty, you again go back to the computation only. You can't again recharacterize the income. That's what I'm trying to say. Because the function of the treaty is not only limited to the chargeability and allocation, it also decides the character of the income. Why not?
That is required because that is where the chargeability gets determined, or I would say allocation gets determined, unless you cap.
So you are allocating it as immovable property, and while going back to the domestic tax law, you are only computing income. You can't then say, no, I will reallocate. How can it be?
Now let me add one more interesting point in this debate. There is a ruling where, in the case of Edinburgh, as you have seen this already, where it said that the Indian entity was operating an IT park, which is again similar to a business center. I mean, an industrial park, SEZ units or IT units working as, or is this similar as a business center? And then they had the question to evaluate whether, if there is a sale of shares of that Indian company by a Dutch entity, and the Dutch capital gains clause had that specific provision that if the shares, the value of the shares is derived from immovable property, then it will also be taxed in India because of the situs. And there they said that since it is used in the business of an industrial park, right? This is not covered by Article 13(4) of the India-Netherlands tax treaty, because it is not only derived from an immovable property, and therefore it went to the business and said that it is not covered by out of the immovable
business
property.
center would mean
Akin
something
to
more than
more
more activity than just
Exactly.
rental.
Exactly. And especially when this thing when you have operation and maintenance, security, stuff like that done over and above just the mere letting out of the property.
Otherwise, they will never get API deduction.
Even other than Chennai property, there are others.
Edinburgh.
Even other than Chennai, there are others which say that business.
Of course, Chennai properties is a unique decision on its own way, so we cannot debate
Even
that.
otherwise,
Because we've had the past rulings which were very clear that if 80-90% is rental income, then you don't look at the other part.
Chennai
But
property is actually
it's change the thinking to some extent. But let's just keep that aside for
I'm
the time
saying,
being. But
even forget Chennai property, even otherwise a business center,
Yeah.
I don't think it will be income from house property. Most of the
possible,
Yeah,
which is what Edinburgh said, and said that it is not income from immovable property. because it is deriving income from business and therefore not covered by Article 13(4). So you can possibly take that argument also to say that it's not covered by Article 6 because it is from a business, and therefore go back to the PE article and argue strongly that there is no PE. So that's the fourth.
No. Once you say that it's a business income, or a domestic tax law, and going to a treaty, presumably you will try permanent establishment test there and then only before going to Article 6. Isn't it?
Because you will see, well, it's covered by Article 6.
Who stops you from saying that there is no permanent establishment and therefore the business is not chargeable?
I would need to examine all the articles.
All the articles. Examine all the
Article
articles.
7 says that if it is covered by a specific article,
Yeah.
you have to deal with that specific
There
article.
is no catch again, because once you go to treaty, decide the remote property, I don't think there is any option for computational purposes
Then
to
you
go
are
to the
applying the
business
BCG
income.
ruling and saying once I have decided the character under
There
the
is
job,
question.
I don't go. So
Otherwise,
again, it will evolve.
otherwise it's a business income, go to Article 7. Why to go to 6?
Are we in a PE situation? Is there a PE possible for PQR
So
in this case?
when you apply the test of disposal, when you
As a
apply
business center.
as a business center, do I have rights on the property? Zero rights. I have no control
I have right on the income.
on the income because of the
Yeah,
units
that's
that I
what
hold.
Yeah.
But I don't have any right on the property. The REIT also doesn't have any right. The manager has the right to do what it wants to do. The professional manager, the investment manager, they have the right. So I have no control
No
or
control.
disposal
And
rights
trustee
to
will be the owner
other.
of the assets.
Yeah.
Isn't it?
Yeah.
Just
Sorry.
complete the.
Trustee is not an agent of a non-resident.
Is this on a charge? Is there any?
Charge.
So we can debate it for that. So if you rely on Vandenberg and you say it is not immovable property, then it takes you straight to Article 7,
Then you're wrong.
and therefore you say no P under that article. The other way of looking at it is, I fix up the characterization under the domestic law, as what you are saying, and then continue with that characterization relying on BCG. The other way around also, for example. So again, these are issues which will evolve, but at least the idea was to sort of put it up to say, okay,
What
this
is
is
your
the,
personal view? Like,
I would say,
we say that both are work in different field and they both will have to be interpreted harmoniously. To that extent, when you interpreting the treaty, you interpret characterization vis-a-vis the various articles of the treaty. And when you're looking at computation mechanism of the domestic law, you again look at the.
in this particular case, I think it's a strong view having regard to the Vandenberg ruling, and because especially in a business sector where there will be a significant service component. So even if Chennai properties were not to be the law, for example, even if you go back to the old scheme of change thoughts, then also there will be a good case to say a business center is a business run by you, and therefore it is not immovable property only because there is an element of service being involved as a part of it rather than just the immovable property. But if it is a pure case of immovable property, it will be a highly litigious situation. If it's just I'm just renting out property, 95% of my income is only rental, 5% is some incidental electricity, security, that type of thing. Then I may have a little bit of a litigious situation. But in a business center, the concept, if it's true to the concept like an IT park or an SEZ park, for example, because these can be those type of assets typically will come under REIT. You will have a reasonably strong position to say it's ATIA, business, a lot of arguments to say it is business, and therefore even in the treaty you go to Article 7 and not go to Article 6. That's what I would think so. Yeah. So that's very important. I'll close this thing here, but just to give you a bifurcation that we spoke about real estate investment trust and infrastructure investment trust. Unlike in a case of REIT where if it's hold directly, the income is taxed on a pass-through basis. In an infra trust, it is not taxed on a pass-through basis. So it's taxed in the end of the trust itself. So that's the distinction that you need to draw because REITs and InvITs are different even in the scheme of the taxation as such. So while you're not discussing that point, I just wanted to bring it on the table so it's there.
Just to clarify, since trustee owns the assets and they are covered by representative assessment provision,
You could still apply 161.
161 cannot apply. When you yourself is an assessee, can you again be treated as an agent? 161 will never apply. That's what clarification I want.
Yeah. So
if 161 does not apply,
yeah.
then it's a straight case of a business income, no permanent establishment, not capital tax.
In this case, we are not applying 161 in this particular situation.
Exactly, because it's trust.
But if it was an infra trust, because here what is happening, the taxability is directly decided in the hands of PQR Limited because the rule say it is pass-through basis
Pass-through,
taxation.
right.
So the
Rental is
evaluate
passed
the
on.
taxability directly in the hands of PQR itself. There is no need to apply 161, 164 like we did earlier.
So,
But if it was an infra trust, for example, if a road asset is a part of this, InvIT
When the income is taxable in the hands of the trust,
trust,
then
then you apply 161, 164. The question will come at that point in time, and whether
in the like manner,
This will fail.
and to some extent.
same extent, yeah. Will you go there or not? Okay. So that's on REITs. Let's take up consortium and AOP.
The residential status of the
The REIT per se as an assessee will have to be a residential, it's a trust in India. So it will be a Indian trust. The beneficiaries, because really,
all are beneficiaries from abroad.
yeah, there have been those rulings in the past where they said that the trust itself is all represented by foreign investors. Like in the case of ATL interest reduction, they had said that if they're all individuals, the trustee is also an individual and the beneficiaries are also individuals, then the ATL bank interest 15,000 deduction
Status as an individual.
individual status as against an AOP. But if it is not, because here you may not necessarily have all, because there is a sponsor will be a resident shareholder, so you may not be able to have a residency which is different. The trust will have to be an Indian resident, typically, because there will be an Indian investor.
Status of
AOP trust.
I don't think they file it as an AOP, but the liability
Is a trustee.
is on trustees of all the beneficiaries put together on an aggregate basis.
Yeah.
Therefore, trust is not an SSE at all according to me. The only representative SSE for the non-residents and the residents
Trustees are,
both.
but you will have to file the return in the name of the trust.
Yeah.
And that trust determination, you will have to say that I am
You said
looking at
trust.
the extra beneficiaries taxation, and therefore the tax income will
It's
be taxed as if
it's
the
similar to a group company return, actually.
in a way, consolidated. But any trust for that matter will have to be looked at. Where is the
You mentioned
determinate
like
trust?
AOP only, na?
Yeah.
That they have mentioned that India Advantage Fund.
Exactly. It's an
Then where they will put the status otherwise.
Yeah, there's no other way. Yeah. So I think let's move to maybe consortium AOP. We have not discussed this as the now the RRC, but then we go to indirect taxation. So we made typical EPC structure. We will not go into too much detail because I'm sure this would have been dealt with in many occasions in the past. Indira Balakrishnan cases and all of those. So we will not go into detail. We just look at the CBDT circular which has been issued and whether it clears the air fully or it does not. So I think that's the basic purpose of this. I mean, most of you will know that the typical scope of work will be offshore equipment supply, onshore equipment supply, offshore services and onshore services. I mean, that's the four broad baskets of work. The critical reason why most of the issues have arisen is because there's a turnkey responsibility given by the project owner that I don't want to look at individual elements of the services. While you may be four different parties doing all the four different works on onshore supply, offshore supply, services, onshore and offshore services, I will only want my entire asset. So let's say I'm building a power plant, I'm building a metro train network. I don't want to say you give me only the wagon and the tracks are being laid by somebody else, and therefore both of you, I don't know whose liability. I want a joint and several liability from all of you that ultimately this will work as a metro train or as a power plant, and therefore I'll be able to run my business as a power plant or a rail operator, for example. So they'll ask for a turnkey, which is that you can start when you all of you four have provided your services, we can start operations. And therefore, if there is anything that doesn't happen, all four of you are jointly and severally responsible or liable to me. So if there is a performance issue, then you all are liable to me. That's typically the commercial understanding that will typically be there.
That could also be umbrella
agreement also. Yeah.
Only one person is like made responsible.
Yeah. I will come to that point a little bit. But so what happens, and there are multiple ways in which you structure an EPC. We are only looking at a consortium structure because you can actually structure the contract in a split contract. You have four different contracts with four different parties, and then a cross linkage of joint and several liability, for example, as you said, or one person taking up the full responsibility or liability, as you again said that okay, all four I will take responsibility for all of the four. Which typically in practice will not happen when the four are different group companies. So if one is L&T, other is Siemens, other is Ishikawa Jima, third is Hyundai, you will not find L&T taking up responsibility for a Hyundai because each one has their own respective responsibilities. But if it is like a group company, then maybe the parent company will say, okay, I am responsible to deliver to you, because if Hyundai India and Hyundai Korea are the two entities who are doing this contract work as a whole, but they have split the work between the two, one for offshore, one for onshore, then maybe Hyundai as a parent will say, I'll take responsibility for everybody. Again, then you'll have to see whether the responsibility is taken as a capacity as a parent or as a contractor or a main contractor and the other is a subcontractor type of thing. So you have to distinguish that. But what we will try and focus on in terms of the consortium is that we have 3 members or 4 members in a consortium for doing all the 4 different activities. We'll come to a case study, but we have different members forming a consortium or an unincorporated joint venture, and they enter into a composite EPC contract. That's typically the structure where the project owner says, I want one contract. You come and all 4 parties be on the other side as a consortium, but I want one contract so that I can ensure that all 4 of you together will set up my power plant or set up my metro network or whatever it is, whatever the job that I have to do. So the project owner and the consortium represented by the 3 or 4 members in a situation will enter into a composite EPC contract which will involve all these different elements. Offshore is from outside India, onshore is in India. There will typically be between the members, because even within the members you have to define what are the rights, obligations, duties of each of the members. So typically the members internally will enter into what is known as a consortium coordination agreement, which will define, okay, member X, you are responsible for supplying the equipments and your share in the revenues is 40%. Member Y, you are responsible for the design and the drawings that you have to send from overseas and your share is 10%. Member Z, you are responsible for the installation, civil work in India and so on and so forth, and therefore they have divided the work among them and what are the share of the revenues. And suppose typically the consortium coordination will also say that if your equipment is faulty, then whatever liability comes for the project owner, you are liable because it is your fault as an equipment supplier. If your design was faulty, then member Y, you are responsible for the entire damages that are required to be paid. And if your civil work or installation was not done properly and therefore there is a liability, then member Z, you are responsible. So typically they will also allocate the risks or the damage sharing between the respective parties in a consortium coordination agreement. Now in that case study that we were looking at, we looked at a situation where we had 3 participants from abroad doing offshore equipment supply, spare supply, offshore design and engineering services, and onshore installation. So we had one Indian company which did all the India work, and the 3 companies from outside were doing design or equipment or spare supply. Composite EPC contract with example Jaipur Metro that was taken up in the case study. And then they had a consortium coordination agreement where, and these are just the principles on the basis of which one will have to decide whether it's an AOP or not. So you put that into the consortium coordination agreement, that there was clear demarcation of work between the 4 parties, that A had to do so and so, B had to do so and so, C had to do clear demarcation of work. The expenses for the respective portion was to be borne by the respective consortium members, whatever work they had to do. In order to meet the bid requirements and for administrative convenience, it had been agreed between the consortium members that the lead member, so D Limited was appointed as the lead member, being in India to coordinate the overall stuff of the D Limited was the lead member, will raise the invoice on the project ground. So there will be one single invoice raised for all the shares that were there. Each member would have unrestricted access to any work carried out by the other members in connection with the project, because if I am supplying an equipment, I need to know what is the design. So unless I have the access to the design, I can't supply or structure the equipment in the first place. If I have to do civil work, I need to know the design of the equipment and the nature of the equipment. When is it coming? When do I have my people ready to come and install it? So I need to know each other's work. But that is only for coordination purposes, rather than I am going and doing some work jointly with somebody. So it was not a case of joint working, but a case of saying, okay, I need to coordinate with you because when we set up a time plan for executing this project, I need to know when you will supply the equipment to the site and when my people need to come and start working on the installation and so on and so forth. So there was an element for coordination and the execution, but there was no case of joint execution, that we both will work together on the installation. That was never the case. It was a clearly demarcated work. All members were jointly and severally liable for satisfactory and successful execution completion of the work in all respects. So, which is a typical project owner clause, which says that I don't want to catch one person, I will catch all 4 of you, irrespective of whose fault is it. Internally, you decide whatever you want in terms of who's going to bear the risk and the damages, but I will catch only one person. That's typically what a project owner will ask for. So they had done that. However, the members have intersely allocated risks and liabilities for their respective scope of work. So, as I said earlier, if the equipment was faulty, then member X A is responsible. If the design was faulty, then member C is responsible, and so on and so forth. Because that's the risk, as we've seen in the OECD community, when you look at the FAR analysis, the risk follows the functions. So when you look at the key entrepreneurial risk-taking function, the CURTs, which are the basis of allocating the risk, whoever is carrying out the work carries the risk of that work. it is not based on a financial capability to bear the risk or not bear the risk. If you have a balance sheet, you can bear the risk and you can transfer the risk. It's not the case like that. The risk will follow the function. So whoever was carrying out that work was given the risk of damages if the default was on account of their work ultimately. And in case of insolvency, which is also a typical relationship, then the others had to act for the insolvent member. So there was this one limited situation where I had to do somebody else's work. That if somebody became an insolvent, or let's say he was not able to execute that work, then I had to execute this work. So that was a limited circumstances. But of course, in a situation like this, the way to sort of the way to put up is that there will be a claim. So let's say A is insolvent in this situation, then B, C, D limited were to do whatever A was supposed to do. Then there will be a claim which will be lying between B, C and D to recover that money from A. So they have really done it as if they were subcontractors to A and therefore recover that money in. Because that's how it will work. And why B, C and D will want to do it is because if they don't deliver the full project, they don't even get their own money. So they have to ensure that they are jointly and severally liable, the project is completed. So they too pick up this responsibility, but as a result of a subcontracting arrangement between A and B. So that's not necessarily impacting the AOP structure or the basis of our. Now, what are the key issues so I think the key issues, maybe the slides removed there, that whether this consortium was to constitute an AOP, that was the first question that was put up. If it is an alleged AOP, if it were to be alleged, then would the offshore supply of equipment, spares and the design engineering is subject to tax in India? Whatever the offshore services were there, whether it be subject to tax? And we'll look at the assuming situation. But let's take the first two situations. And the sort of understanding on this was very clear until the advanced ruling started taking some different views, that if you are not doing work jointly or not earning at a net profit level, but really earning at a gross profit, dividing your share at the gross revenues level, and you're not working jointly or in a manner, just coordination would not be working jointly. Jointly is when we both are doing the same presentation. But if I say I will do case study 1 and case study 2 and Paresh Bhai will do case study 3, then you're not working jointly on it. He's doing case study 3, I am doing case study 1 and 2, really speaking. So we are working our respective work or scope of work, and that's the way it is. So where there was no situation of working jointly, then the Indira Balakrishnan or the Vanwood ruling which had followed the Indira Balakrishnan principles very clearly said that this is not an EOP. However, subsequently advanced ruling in GeoConsult and Alstom and a few cases went on two issues. And they started looking at, when this whole discussion around looking through and looking at and the dissecting approach, or looking through like a contract, they came and said that you have to really look at a contract. You cannot approach a dissecting approach. Now here there is only one contract. It is not a contract only for supply of equipment, which is a normal import, not taxable. There is no doubt on that. But the contract really is not only supply of equipment. The contract involves you have to make a design. The equipment will have to be as per a design. Somebody will have to supply spare parts, and somebody will have to actually put that whole equipment, everything together and work as a metro station, for example, which was the metro project that was taken here. So the contract was really for supplying on a turnkey basis the entire rail network, which would have worked with the wagons, etc. etc. In which case the advanced ruling went and said that when you look at this as a composite contract, you do not really have the ability to split this into the different components. And the look at approach will require you to necessarily look at this as one consolidated contract. You cannot split the contract here. And there they said, okay, once you say it is not just a supply of equipment, but is a commissioning and installation of a contract, then really the property in the ownership in the property will only pass at the time when the installation and the commissioning is done at the location or the site of the project owner. And therefore you cannot say I have imported from outside, the property passed, risk or title passed outside India, and I have only done this. And therefore they bifurcated this into saying, no, you have to look at as a whole thing, not dissect it, and therefore you cannot determine the individual components separately, and you have to tax it as a whole. And when you tax it as a whole, without looking at what each one is doing for the other, you will come to a conclusion that this is done jointly by all of four of them together, and therefore an AOP. And once it is an AOP, you cannot separately evaluate the taxation of the individual components of the work that is done. Now, there was an old circular of the instruction of the CBDT, which had in the case of power projects, when PSUs were giving up the contracts on EPC basis for power projects, said that even in a situation like this, where all of four of them come together and ask for a contract, but if there is clear demarcation of the work, and the roles and the responsibilities, the instruction very clearly said that this will not become an AOP. The issue arose when that instruction was withdrawn sometime in 2003 or 4. And then that period from 2004 or something, 2004 or 5, I think, when this withdrawal happened, the tax authorities and the advanced auditing started reviewing a view that now the instruction is no longer there. The way they interpreted Indira Balakrishnan to say that, coming together for executing this composite contract, is like one activity, and therefore even if you share at the gross revenues level, you are really all doing one common activity. All of you are playing your respective parts in that activity, but you are still one composite whole, and therefore this should be treated as an AOP, and you have to tax the full AOP on a full basis, as if it's a, you tax it as an AOP, and typically in an AOP, because one member is a resident, the AOP becomes an Indian resident under Section 6, and therefore the entire income gets into the tax net in India. Now, fortunately with the CBDT circular, which they very clearly now laid down, the rule that, which is again I think what the court has upheld as a position, that if you are, there is a clear demarcation of the work that is to be done. Each one bears their respective costs or expenses and has control over the men and the material which will be going into their respective scope of work. And you are not sharing at the net profit level, but only taking the gross revenues out of this. When you satisfy these conditions, the CBDT has again affirmed the position that it will not be treated as an AOP, so long as you satisfy these 4 conditions. And the way 4 conditions clearly laid down, all dealing with, to my mind, only demarcation of the work and the risk and the liabilities being attached to the specific work. Now, there will be, the way the CBDT circular is structured is that they have said, if these 4 are there, you are not an AOP. If there are any other instances also, then also you may not be an AOP even if you don't satisfy this 4, which is then relying on the Indira Balakrishnan, because the CBDT circular does not exhaustively deal with all the situations that arise, but they have only given 4 instances of what they are saying. And therefore they are saying if you are outside of this also, you may be covered by the Supreme Court cases and the Indira Balakrishnan. Let's leave that aside because that's not what is relevant here. I think the other part of it, which was to say that if it is an AOP, let's assume it's an AOP just for theoretical sake. Would the offshore equipment supply could have been taxed separately? Now when you look at the offshore equipment supply, the actual work of equipment supply is only done by member A in our example. It is in a factory in US, it is a US member, the factory there produces or manufactures the equipment, and the equipment is shipped into the. Now we all know that the AOP has to be treated as distinct from its members. Now A Limited is a member of the ABCD AOP, but it is not the same thing as ABCD AOP. Now here is an activity which in the real sense was executed only by A Limited. There was no doubt that BCD contributed anything in the manufacturing facility of A Limited. They have not even gone there. They contributed nothing in terms of that. Now, could it therefore have been looked upon, and that's what I want to open up for a debate also, that the AOP contracted the equipment manufacturing and supply to A Limited. And therefore there is an independent transaction. So while the AOP is one whole, which was required to do a composite contract and deliver the entire project, there is an element or a subcontracting of the work by the AOP to A Limited, because in that work nobody else participated in any manner. And therefore, when I prepare the income of the AOP, I will have to, on a transfer pricing basis, assuming A Limited holds more than 26% interest in an AOP, because we have to apply transfer pricing there. You can, on an arm's length basis, determine the cost of the equipment that is supplied by A Limited, and therefore in the AOP's P&L, I will debit that as a cost and not necessarily look at the cost of A Limited, decide what is the net income of the AOP. Now, which means that I am deeming a transaction between the AOP and its members. At ALP, assuming it is more than 26%.
There will be a markup.
There will be a markup, obviously.
If there's a markup, that means there's a profit is being earned, a share of profit is being earned by a member of AOP from the AOP.
From the AOP.
So that will be available as reduction.
And that's the question that I want to open up.
It should be first of all cost to A Limited rather than cost to the AOP.
Yeah, so exactly. So let's say if they produced for a $90, the ALP is say $100, and the AOP has earned $300 out of the composite contract. Let's say even they are not bifurcated it between the respective parties. Now, will the AOP say the deduction is $90, which is the cost of A Limited, or will it say $100 is the cost for the AOP because that is the price that we just got from the member. And that is the agreement with the AOP. Now, if you look at 40BA of the, which restricts deductions for an AOP, it restricts deductions when it is in nature of salary, commission, interest, coming brokerage, or remuneration. So that's the 4 or 5 situations. Yeah. So now whether the cost price of the products supplied by A Limited to the AOP would amount to a remuneration which will be subject to a disallowance under 40BA, which implies a partnership also to an AOP, two different sections that apply there.
So, Vishal, before going to that, what are we taking the taxability of offshore supply when in the hands of A? First, this will be the second in the hands of AOP.
Yeah.
So, in case of an AOP, we are saying
So
that offshore supply will not be taxable at all.
Right.
And
AOP will be taxable on the entire 300 of its revenues that it is getting. Let's assume it's an AOP.
So indirectly, the profit which is there on
Can we
offshore
take it out?
supply
Can we
is
take it out?
already being taxed
Yeah.
by way of 300.
Yeah, but now 300 is my gross receipts. So I have to have deductions, expenses.
Yes.
Of 90 whether
Now,
they can
my expense really in the hands of A Limited is only 90. Whereas, insofar as the AOP is concerned, can I say the expense is the price at which the A Limited would have sold the equipment in the marketplace? It is $100. And that being the price, I should get a deduction of $100 for my $300 and not $90.
Can you say that AOP member is a subcontractor? There is a vast difference between a consortium member whose responsibility and rewards joint in several versus the contractor's payment. It would have been a contractor's payment, answer is yes, but can you say that it is a contractor's payment?
Yeah. So let me put this into a perspective and say that what is the AOP? The AOP is only when there is undoubtedly some common activity carried out by the members. Okay. Now we have this activity where I have to deliver a composite contract. Let's assume it is an AOP because we are assuming that it is an AOP. We are doing some joint activity. Now when I am doing this joint activity, is the manufacturing of the equipment a joint activity? Undoubtedly no. Because the manufacturing of the equipment is only done by A Limited at its factory in the US. The BCD have no access, no control what it is.
Vishal, by that token, every activity of all the members you can carve out.
You can carve out, exactly.
In case you back to carve out.
Absolutely. I'm just giving an example of A Limited. Yeah. Of course, there may be a distinction that you may be able to draw to say that equipment supply is not remuneration, whereas a civil subcontractor work is remuneration, for example, because that is human involvement and service element. Engineering design services fees is a remuneration possibly. But if it's a pure equipment supply or a spare supply, which is like a sale of goods to the AOP, that wouldn't have come into
by
the
that logic.
That's the
You
difference.
come to the same result as if it is not an AOP.
Now you need to bifurcate.
You're right, sure.
Absolutely.
Supply will again be a cost.
You're right. So now let me give you the reason or
So services also will be a cost.
Say, Paresh, your
No,
problem
but
is the
that's
cost will get
this will be treated
not
as
the profits.
remuneration. That's
No,
all.
Of course, services undoubtedly
That
will
will
be
be
a profit.
disallowed.
But it will be
That will be
a
disallowed as payment to
then
member.
what Parishbhai is saying that we will be practically back to
Zero,
square
right?
one.
The same thing.
You're coming back to zero.
Square-
So let me answer that.
Okay,
Let me answer that. What will happen is that there is a risk will have to be attributed when you do a transfer pricing, and assuming all are 26, subject to transfer pricing, you will have to attribute risk to the different functions that are being taken. Now, the manufacturing risk is not as high as a full turnkey contract delivery risk. So therefore, when I work out my transfer pricing on a far or relative far basis between the member and the AOP, transfer pricing is the answer really to your question. The answer will be saying that, okay, the AOP has taken some risk of delivering a turnkey output to the project owner, whereas A Limited has taken a limited risk of only manufacturing an equipment and giving it. He doesn't care now further of whatever is the turnkey happening or not happening, because that's the AOP's risk.
But
That is the separate AOP's risk, where the AOP is involved.
Had the equipment not been there, it wouldn't have started only.
So let's
generally,
assume-
Generally, why there is a foreign player supplying equipment, because the key skill set lies there.
Appreciate. So let me take a situation where instead of buying the equipment from A Limited, they had formed this unincorporated JV, AOP, fully AOP. Let's say they are doing that everything. They would have gone and bought this equipment from an outsider. What would have happened? The risk would have been still of the AOP of delivering the composite contract.
Yeah.
And the
Then
equipment
that's-
supply risk would have been of the third party who was supplying. Because that happens today also. You as an AOP buy something.
In real time, would say that if your equipment was faulty, then your risk would be much more than the supply of equipment itself.
Absolutely.
Because then service is also affected, then the installation is also affected.
Correct.
All this risk will be on the equipment supplier if the supplier is equipment is faulty.
Correct.
So you will end up with larger risk attributed to the supplier than the actual risk which the third party would have taken.
So let me again put that. You'll have to bifurcate the risk being taken between the member and the risk being taken by the AOP. The member, when it is contracting separately with the AOP, it is taking risk for the manufacturing activity. When the AOP has in turn committed to the project owner that I will give you a turnkey, which means that there can be a risk arising out of the equipment, but also the services get impacted and the civil work gets impacted, which is what that risk is between the member and the AOP will be attributed to the AOP.
But
therefore, you will give a profit margin to the AOP to that extent.
My thinking is,
No,
you will never be able to attribute.
Then in this case, if it's an AOP, if you come to a conclusion, the facts are such that more often than not, it would be constituted an AOP, because generally they do not declare themselves as an AOP. Generally they try to say it's not an AOP.
Yeah.
Does it make sense to suo moto
Allow for this.
treat that we are an AOP, file a return as an AOP and try to claim all these deductions?
Possible. Only where you have to be very careful is that where this restriction on the allowability of remuneration under 40 APA, a lot of the services element will definitely be qualified as services. At least insofar as equipment supply is concerned, I would like to believe that it is not remuneration. Because equipment supply is not remuneration, equipment supply is sale of goods.
Actually, for services also there is a way we can insert a third party or the
That's a different issue. That's a different issue. I leave that aside.
I would think like this.
Would it not make sense that you form a company and where all the...
Which is obviously there. Which is obviously there.
If you form a company, the point
There
is
is no
what will happen is the repatriation back, because the profits will be stuck here in India. And AOP, I don't think there will be no DDD. Their profits will be
You know what
repatriated
happens
back
also
without
now,
tax.
that here most cases of a practical situation, they don't get income at a net level. They say out of the 300, 120 is at the gross level they distribute the revenues, or their share of the revenues is determined by gross level. So you will not have a situation where they can do a company and then say, okay, I will share only the net profit, because that will commercially not be the feasible structure for them. Most of the
But when we have say connected parties, that can be certainly.
We'll come to associated enterprise.
Last question.
That's
That's the last
anyway
question. So we'll come to AEs, where they are related parties. But I would say, so okay, we can bring it to a
But I
place.
think there's when we're talking about it, it's a net level or the gross level. And we're also looking at there's a joint management. So actually both the questions are interrelated. In the sense that if there's a joint management which would imply functions, which would imply expenses, which would imply net.
Possible.
So obviously if there is no joint management and each one of us do our own
Respective
activity, then obviously there is no functions which are
Common.
functions which are common or functions on which expense needs to be attributed, then we again go back to the gross level.
Gross.
So whether it's gross or net is actually dependent on
The functions, the division of the functions, the demarcation of the work.
compared to transfer pricing.
Absolutely, absolutely. So the question really, just I wanted to put up that, when we looked at the rulings that were coming out, they went on the basis that once we have looked at this as one single contract, there was a specific question being asked that even if it is an AOP, would the offshore equipment supply be separately taxable or not taxable? They went on the basis whether I can, dissect the composite contract and look at one component. My question, which is what the rulings have approached, and they looked at the issue in that context.
Which ruling?
There's a 345 ITR. One is Alstom, for example. The other is Ansaldo. And I think the two of them which were Ansaldo didn't do this, but Alstom did this.
Alstom did, and
there's one more 345 ITR, which is I'll give you the citation.
in fact they held very wrong and it was referred back for recurrence.
Yeah. So 345 ITR,
There's no P.
page 30 something.
Maximum
Page 33, this issue is dealt with, but you can look at
So which three?
345 ITR at page 33. The issue is dealt with on this segregating the
But
income from
ultimately,
offshore.
the AG of Delhi High Court has settled that issue basically, and that is exactly what is the circular also follows.
Circular also follows.
So that much is.
Now only issue is that the circular does not cover cases where A, B, C, D limited are related parties. What you are mentioning where they are associated enterprises. The circular says that this will not apply where the members are related parties. And the fear that the CBT has, and to some extent rightly, is that if they are related parties, they will try and maximize the revenues being put into offshore equipment supply, which will never be taxed. in the normal course, if they are not AOP and you take a dissecting approach or look at each component separately, then you will try and maximize whatever is there into equipment supply.
That's a tax avoidance aspect.
That's a tax avoidance aspect, and therefore in that again in the Dongfang ruling in the Kolkata bench.
Also was on that only. Answer was also on that.
And in the Dongfang, Pramod Kumar has given a very well reasoned order, and basically what he said there is that the Kolkata ITAT, I don't have the citation, but what he said is that unless you reach a conclusion that you have unreasonably loaded up the value of the equipment supply or the offshore components which are not taxable, you cannot disregard the two segregations of the contract and the work done, and therefore you will respect the two different scope of work and the price is being paid for that. So in a related party, again it will be a question of transfer pricing to justify whether this is there, but the principle should equally apply to my mind, and therefore the stability principle.
The consortium agreement, which is a composite agreement, would also determine the roles and responsibilities of individual consortium members vis-a-vis the project owner, or we are only talking about the coordination agreement which will determine that which will be interested if project owner is not a party.
So general recommendation is now that that when you have this consortium coordination agreement, you should also file it as an annexure to the main consortium contract.
The project owner is party to it. So
project owner is not a party, but is intimated and aware of it. At least you have filed it with them. That is one suggestion that you should keep in mind, because then that will help.
Not only the project owner is not interested, he does not want to know what your problems are.
He's saying, for me, you all are responsible jointly and severally, so I don't care because you're going to give me a turnkey answer. I don't care about it.
If you file that separate thing that we are splitting the work like this, and if say the project owner objects to that, then
you can't do that. Then you can't. No,
because we want
commercially come up
there. I'm objecting to it.
Same like contractor versus the joint owner. You further argue that the sum total of default risk will be much larger than the attributable risk at the threshold of the contract. Your theory will fail.
No. So let me let me
Sum
say.
total of default risk versus the attributable risk at the beginning of the contract will be quite different.
No, at the beginning of the contract means
When you structure the contract,
right,
you have
all
risk
four parties.
with the equipment, risk associated with the offshore supply services, risk associated with the onshore, etc.
So what do you mean by default risk in that case?
I'll tell you. If a equipment fails, default risk will be much larger than the equipment price itself.
Right.
Because other work is affected,
right,
which is spoiled.
If the design is faulty, for example, which is only 10% of the value of the contract.
So therefore,
of course, the person concerned, the member concerned will have to.
so therefore, your theory of transfer pricing will fail in that case.
But what you have to do is that when you work out your transfer pricing, you will not be able to have the hindsight of saying what didn't work out.
No, I will argue
you will have
that
to
your default risk is much larger. Your default risk is much larger than the attributable risk. So how can there be a contract between the AOP and the AOP member?
No,
you are not able to attribute.
See, the contract between AOP and AOP member is contemplated even under the service tax.
No,
so it is not that this cannot be done.
I'm saying when you apply transfer pricing risk attribution, then I can argue, department can argue, your default risk is much larger than what you attributed. Therefore, I don't agree with this.
But that would happen in any situation, no? Because let's say you end up into a Kingfisher, for example. They invested X dollars. They gave a guarantee much more than that X dollars that they have invested, and they have to suffer to it. They have the full responsibility liability on their own account. So any promoter will have a situation. That's a business call you have taken. That okay, I know that this default risk is unlikely to arise because I'm sure of my work, it will not happen. In a professional indemnity case also, you have situations where the liability risk in many cases is thrice the value of the fees. So you are only going to get X fee, but the practicality or the commercial reality is that you accept a 3 times liability because you know for a fact that while you are only defaulting, for you the value is not high, but for that person on the other side the value is much higher because your small contribution will impact his whole business model. Because he is investing 6,000 crores, you are only investing 500 crores.
And this could be situation even with third party also.
With third parties also. Today you have the situation where your professional indemnity risk or any other situation may be actually twice, thrice the actual fees that you are going to receive. So that commercially is possible.
So another question is whether the fact that it is a divisible contract or an indivisible contract would make a difference.
Again it will go back to the issue that you made, that are the functions demarcated or not? When you say it's divisible, that only at that point in time the functions will be demarcated, because if it's not divided at the work level, how will you say who's doing what? You know, so you have to define the work qua A, B, C, D in our example. You can't say A, B, C, D together will do this. Then it is not achieving, then the AOP will clearly be applying because there's no demarcation of the work in that sense. So you have to demarcate.
And also project owner would have recognized who the consortium members are, which is why they would have given
See,
the...
in reality today what is happening, the EPC has happened because one person has the ability to do the entire contract. There is no way, an L&T cannot go and get some equipment and Siemens cannot go into civil work and, Ishikawa, Jima cannot come into